Hello and a warm welcome to another edition of Econoday Unplugged. It's Tuesday, the 20th of August, 2024, and on today's podcast, we have Terry Sheehan on US East Coast, Max Sarto in British Columbia, Brian Jackson in Sydney, and I'm Jeremy Hawkins in London. Earlier this month, the VIX index, the so-called market fear gauge, saw its largest intraday swing on record and hit its highest level since 2020 in the midst of the COVID pandemic. Now, it may not be the best measure of volatility, but there was clearly a marked shift in investor sentiment following the unexpected BOJ tightening at the end of last month, and in particular, shortly after that, the surprisingly weak US July employment report. Equity markets around the world tumbled, bond yields slumped, and futures markets priced in more than a 50% probability of the Fed easing by a full 50 basis points in September. However, what we might dare to call a return to a sense of market normality has come about remarkably quickly, with many stock market indices once again close to record highs. So economy-wise, what's it going to be? A hard landing, a soft one, or indeed no landing at all? So to Terry then, Terry, I guess we've got to kick off with that employment report. Was July really as weak as many seem to believe?
Probably not. July is typically a difficult month to get the numbers exactly right, with holiday travel and changes in hiring patterns around school years. So probably it really wasn't as weak as it looked. Also, the July numbers have a tendency to be revised higher. So I'm looking for the August report in September to correct some of that perception of weakness. However, the unemployment rate did go up 0.3%, but some of that is a reflection of an expanding labor force. So overall, it really wasn't that bad a report.
And as ever, presume we should never take one report at face value. We should be looking at the last several and try and stick a straight line through it.
Absolutely.
Right, tomorrow, if I've got my dates right, we'll get the annual employment benchmark revisions. I noticed there has been some sizable talk about a possible downward adjustment. Is this going to have any implications for the Fed?
Probably not. Right now, what they're looking at is a labor market that has been cooling along the lines they've been anticipating, and inflation coming down slowly but surely. And the underlying pace of growth seems to remain at a moderate level. So they're well positioned for a rate cut in September.
Okay, I should clearly, that's the employment report kind of taken care of. In terms of the rest of the numbers then, let's have a quick look at the July CPI, which obviously is a big focal point for investors as well. That was down again. The core was also down, weaker than expected. I also noticed that the New York Fed inflation expectation survey, that showed the 3-month number, I think, went to its lowest level on record. So is it really the case now that conditions are pretty well there for the Fed to come out and cut in September? And in the light of, well, some of the recent speculation and all the market volatility, is a 50 basis point cut a realistic possibility?
I do not think so unless we see some truly unexpected deterioration in the economic numbers. I think that Fed policymakers have indicated that they are being cautious and patient. And despite the fact that we are hearing talk of the greater confidence they've been wanting to see before they cut rates, it's not by any means a worried kind of commentary coming out. So I think 25 basis points is the most reasonable expectation at this point.
And do you think, if they were to do 50 basis points, it could actually backfire in the sense that the market might read such an aggressive move as really indication there are more problems there than perhaps people expected?
Yes, I think that would be the case.
Okay, let's have a couple of other things in terms of Fed policy anyway. Wednesday, the FOMC minutes, crucial, I suppose, this week. Mr. Powell chatting away at the Jackson Hole Symposium on Friday. What do you think is going to come out of those?
Well, I think the FOMC minutes at this point, when they come out, they'll be 3 weeks old. The meeting occurred before we saw that July employment report,
Hmm.
I really don't think that they're going to have a lot of impact. I think everybody's waiting to hear from Chair Powell on Friday.
So what do you think Mr. Powell's going to say on Friday?
Well, I think one thing he's going to do is make a few comments about the independence of the central bank, and that any rate decision they're going to make will be based on the data and not the political circumstances. But I do think we are going to get a fairly solid signal that, yes, Fed policymakers are looking at a rate cut in September, with the warning that no decision is made before the meeting.
Okay, fair enough. The last question I want to ask you was a Reuters poll, I think it was out yesterday, which showed where are 55 out of 101 economists surveyed believe that the Fed will cut the funds rate by 25 basis points in September, but also again in November and December. Do you think that's plausible, or is that too aggressive?
I think it's probably a little too aggressive, but I don't entirely rule it out depending on what the data comes in on. I really think, though, we're more likely to see 25 basis points in September and another 25 in December.
Okay, fair enough. Anything else from your side, Terry?
No, this week it really is all about the Fed.
All about the Fed. Brilliant. Okay, thanks for that, Terry. Max, let's move across to you then. Canada. Well, I suppose particularly after today's inflation update, there wouldn't seem to be a great deal in the way of another Bank of Canada cut in September.
That's highly possible, and I think markets and economists have already factored in more rate cuts because again, this is just a unwinding of aggressive rate hikes. So it's not like the bank is trying to be super loose. It's actually still a little bit restrictive. So I think that's where we are now.
Okay, now where do we stand on this Canadian economy then? So in the intro, sort of talking about generally in terms of whether we might get a hard or a soft landing, whatever that might actually mean. I mean, clearly for Canada, we had an unexpectedly weak July employment report, a bit like the US, second straight decline in the actual jobs numbers. Retail sales are looking at, as of the latest figures for May, they were, I think, 0.7% below, in volume terms, below where they were at the end of last year. So there's been no growth in consumer demand in terms of retail sales. And indeed, I think they're expected to decline again in the June data on Friday. So are we actually talking about an increased possibility of a hard landing for the Canadian economy now?
I wouldn't call it an increased possibility because it's hard to gauge, like Terry mentioned, the summer months. I was surprised that south of the border, I closely watched the ISM indexes, and it's there's weakness beyond normal summer slowdown in manufacturing and even in the service sector. So obviously compared to the more dynamic, bigger economy south of the border, our economy is smaller, and but we have different factors like very strong immigration policy. So we have both supply and demand of labor. And then, the influx of newcomers really helped us deal with the labor shortages during the pandemic. But now these people are consumers too, and that's sort of feeding into the inflation. But the important point Governor Macklin made last month was he's now looking at both risks, upside and downside equally. And I made a short visit to Toronto this month, and I went to the underground shopping, food court, and some of the retail stores, high end, and one particular shop that really carried on during the pandemic now closed forever. So there's obviously a sign of a slowdown and fewer summer jobs, but as Terry mentioned, it's a little bit of a seasonal abnormality there. So we have to see what's going to happen in the fall.
Okay, I mean, so you mentioned something about the real economy now. I was going to ask you because looking at the July policy deliberations, I mean, clearly some officials were suggesting that they're increasingly worried about a further deterioration in the job market, and that might in turn feed through into weaker consumer spending, etc., etc. Do you think the bank now is attaching, let's say, more weight to what's going on in terms of the real side data than perhaps in the past it's been mainly just concentrating upon the inflation numbers?
I don't know how to sort of break things up into different pieces of the way you look at it, but it's more like they've always looked at both sides, but now yeah, coming up to this back-to-back rate cut, they started to worry more about the downside. But now they know that inflation doesn't always behave as they wish. So I think they're just looking at the both sides. But compared to Australia, where the governor said they considered a rate hike, and the board didn't discuss a rate cut. So that no, the inflation is still like 3.8 monthly data, and ours is 2.5. So we are sort of ahead of the game. We started raising rates earlier, so cutting rates earlier than other economies. But yes, that's a sign that maybe some of the board members are more concerned about the downside.
Okay, fair enough. Any else on Canada?
We're good right now.
Okay, right. Well, let's get across to Japan, where it's all been happening. And I guess we've got to say the yen in particular has been, well, volatile with a capital V following the collapse, well, albeit possibly only temporarily, of these long-standing short yen carry trades in late July and early August. Now, I think the surprise BOJ tightening was clearly a factor triggering the wave of yen buying. But it was also subsequent comments from the central bank to the effect that it wouldn't hike interest rates when markets were so volatile that helped to stabilize asset prices pretty well everywhere. So, I mean, the key question, I think, Max, for you is, what do these recent events mean for the BOJ's, if you like, stealth tightening policy going forward?
Some people may be giving too much credit to what the BOJ has done and the officials are saying. There's a bit of a misunderstanding when BOJ started normalize or gradually raise rates. It's compared to other economies, their rate levels are extremely still accommodative, and probably the terminal rate is going to be around 1% or maybe less. So you see, if you compare it to what the Fed's doing or what it's indicating to do, the BOJ alone cannot really move the dollar yen in a major, way. It's just that the governor is a serious economist, but he sort of sometimes makes some comments, like tongue-in-cheek comments. So we can't really tell whether he's playing dumb or he's being serious. And I think some of the core debate, I respect the governor. He has his own idea of normalizing their policy, but the deputy governor Uchida, he's the one behind all the previous measures and now normalization. So we have to watch for comments from somebody who refuses to meet journalists often and who's been really quiet these days.
Okay, fair enough. But I've got to ask you, so just going back to the yen. I mean, we saw the dollar yen go from over about 162 or so down to around about 144 in a space of no time at all when we start to see these yen trades being unwound. And it did seem that could have gone a lot further had we not had, I think it's the deputy governor, was it, from the Bank of Japan actually intervene verbally. And I suppose my question to you now is that for a long time, we've had the MOF and indeed presume the BOJ worried about the yen being too weak. Are we getting to the stage now whereby they might be worried about it becoming too strong, and to that extent, perhaps slowing the pace at which they take the normalization of policy forward?
I know where you're coming from, and many economists, market participants are coming from, but you may be mixing the two factors into one question. first of all, the BOJ cannot raise rates so fast because I don't know how to say this, but it could still affect the real economy, even though the people like us, we or as when we buy things and borrow money, we don't think about real interest rates. Even the central bankers can't really pinpoint. So we look at the nominal numbers, right? So for them, even if it's a minor hike, it's the people in Japan are so used to close to zero interest rate when they borrow money, and that's gonna if they raise rates faster, then that's gonna hit the small businesses, which basically employ about 70% of the workforce, and new homeowners or so. It's a very strange world of okay, raise rates so that you can fix the weekend, but that's a wrong argument. And if they raise rates, oh, the BOJ raised rates, so that's why we had weaker GDP growth. So that they could be criticized whatever they do. So I think they're being careful. But when I told my contacts in June when I visited Japan, I said, I think the BOJ should raise rates and avoid the mistake they made back in 2007, not fast enough. So then we got hit by the global financial crisis. So they missed the chance to normalize their policy. And I think they went ahead in July instead of September. That was my call. They had a very good, not insider information, but they have people all over the country. So they did informal interviews with businesses, and they had a good hunch that they didn't have to wait for the official monthly labor report to see if the high wage hike at major economies are spread into smaller economies. So I think they sort of ignore the rule of waiting to confirm the hard data and went ahead. And I think I'm just imagining they never say yes to this argument on the record, but the LDP ruling party's leadership conventions happening in September, and the Kishida was so unpopular he had to step aside. And they don't have any guarantee that new leader is going to be leading the economy in a better way. So, it's a huge risk, just like, what kind of a president the United States is going to have. So I think the BOJ thought about it and then attached the argument later that, see, our policy, monetary conditions are so accommodative. So that's what's going on.
Okay, it's going to be interesting what happens as these interest rate differentials start narrowing those, the Fed cuts rates. You mentioned there, so about the Liberal Democratic Party convention in September. Obviously, we're going to get a new head now. Do you know who's going to get it? And do you think they'll have any, in a nutshell, do you think you have any implications for financial markets?
So far, we see like 11 candidates for this position. Obviously, maybe the older generation will support the former defense minister Ishiba. He tried twice to get the job, didn't get it. He got really close, but defeated by Abe. So he may have a chance, but that means old guards on a musical chair game and getting the job eventually, but I don't think that's what the young voters want to see. So I don't know. It's a little bit too early to make a call, but hopefully it's going to be a more interesting game than just the older guy gets the chair before they just hits the bucket.
Okay, fair enough. Anything else, Max, on Japan?
Just wanted to go back to the point you made about dollar yen. Mm-hmm. I had warned about overbought dollar positions earlier, and that's what's happening. And I think the yen regained most of the loss for the year, but for us regular guys, it's still too weak. I can't bring money back from Japan because we would incur a loss. So the key point, I think everybody in Japan is hoping for a change to see a stronger currency that they have, is for the Fed to act decisively, maybe aggressively. So I think that's where we stand at right now.
Excellent, as ever. Time will tell. Okay, well, thanks, Max, for that. And I guess we'll now shift across to Brian in Sydney. So, Brian, let's start with China. Key interest rates reported today, but of course that was only after the surprise cut late last month. So have the latest data offered much hope that the economic recovery is gaining any traction?
It was sort of a mixed result. There was nothing, really. I think, there was no sort of major breaks in the numbers. They were sort of just plugging along in the same sort of year-over-year growth rates that we've seen, in the last few months. And if you had a look at what the official characterization of the data were when the numbers came out last week, again, it wasn't really a big shift in the tone of how they characterized the data. They just said, the economy is generally stable and making steady progress. And then they sort of trotted out the similar sort of cautionary warnings about the risks to the outlook, just about how the external environment is still a challenge. They still got to try and transition from old growth drivers to new ones. So they sort of trot out the same sort of language, about how there's all these difficulties and challenges, but they gave no indication that they thought a major shift in policy settings were required. Particularly after they did cut the loan prime rates, only slightly last month, and then again, today they left them on hold. So it seems like, notwithstanding the bad numbers that we continue to get in the housing market, they don't think that there's a lot of scope to really do much on policy settings right now. It's more tinkering around the edges.
Okay, I saw something the other day looking at some of the loan numbers. I think suggesting in terms of bank lending anyway. It's weak clearly across all the sectors, but it recorded its first yearly contraction since July 2005. Do they make any reference to that? Because is it the case they think they might have to cut interest rates again to try and get borrowing to increase?
Yeah, that I think was before the main activity data that came out last week. So they had a chance to refer to it when they always put out a bit of a statement when the main activity numbers come out, and they didn't really refer to it at all. They just again obliquely referred to difficulties and challenges and replacing old growth drivers with new ones. So you could perhaps argue that they're indirectly referring to some of this stuff, but they definitely weren't explicit about it. And as we saw today, they haven't decided that you needed to reduce those loan prime rates further. So they seem for the time being to be relatively comfortable with current policy settings.
Okay, I'm going to ask you before we move on about inflation. I got it right. The July rate was up to 0.5%, up from 0.2, but the core rate, at least if you strip out food and fuel anyway, was down to 0.4%. So again, must be some sort of concern that domestic demand simply isn't recovering fast enough to generate any real inflationary pressures.
Yeah, I think that's true. It's just been sort of tracking around those really low levels for a long time now, and if you look at the the producer price numbers too, that's been firmly in negative territory. So there's no evidence of sustained domestic demand pressures, pushing up prices, and as we've said, the activity numbers are pretty steady as well. So it's kind of in a holding pattern now, but they don't seem to think that there's any scope to really aggressively ease policy to try and boost the activity numbers and B sort of get some of those inflation numbers a bit higher as well.
Okay, Right, let's go across to New Zealand then. There's been a few surprises on central bank interest rate moves over the last month or so, and certainly one of them came at the RBNZ, last week, wasn't it, when they cut rates by 25 basis points. Now, I've got to say that seemed to come as a surprise since what was only in May time that the bank was suggesting there wouldn't be any cut until a year or so or something like that. So, bottom line is it's something of a U-turn. So, what's changed?
Yeah, well, they seem to be more comfortable that inflation is going to, get down to where they want it to be, but also be a bit more concerned about, the growth numbers. So, they were, if you look at the statement, that they're definitely referring a lot to some of the recent activity numbers, which seems to have surprised them to some extent on the downside. And so, they mentioned that, well, it looks like the tight monetary policy that we've had in place, and also tight fiscal policy, seems to be really restraining domestic demand. They also just mentioned falling net migration and external factors as also weighing on growth. So they seem to have become a little bit concerned about the growth outlook, while at the same time a bit more comfortable that inflation is going to behave itself as they want it to, obviously. So, you put those two things together, and then that does open up the door for the rate cut that we saw last week.
So a couple of things then. One, does this mean now that investors need to concentrate perhaps a bit more upon what the real economy is doing? And two, having come out and delivered this surprise cut this month, is there a chance of another move, do you think, when we get to the next meeting in October?
Yeah, I think that's both those points are valid. They're always obviously looking at the activity numbers as well when trying to set policy, but mindful of their inflation target. But as they, I think, become more comfortable that they are going to get inflation back around where they want it to be, they are definitely going to pay more attention to what's happening in the real economy. And so that's on the table, obviously, going forward. That said, they still stress that monetary policy needs to remain restrictive for some time, but you could definitely see rates being cut 2 or 3 times, and they still characterize that as a restrictive level of policy rates. So they're giving themselves the option of cutting further in upcoming meetings, while still characterising quite accurately the overall stance of monetary policy is still being restrictive.
Okay. Do you think the shift has, I don't want to overplay it, but has caused any sort of damage to the RBNZ's credibility, given that they appear to have gone from, in the space of a very short time, a central bank where the talk was, well, look, they may have to hike interest rates again because inflation is too high, to all of a sudden this, this cut out of the blue and seemingly the potential promise of more to come?
No, I don't think it's. I think over a long time the RBNZ has sort of established a track record for being fairly reliable and credible on its monetary policy settings, and I don't think people are going to mark it too heavily just because it's decided now is the right time when they've responding to some of the data that they're seeing. That's obviously what central banks are supposed to do, and if they're a little bit more concerned about the growth outlook and they're a little bit more comfortable about inflation heading lower, then you would expect that they would start to at least consider easing policy to some extent, and that's what they've done. And I think it's also worth mentioning they did raise rates very aggressively over the end of 2022 all through 2023, and so rates are at quite a high level right now, and so there is I think some scope to pull it back and still maintain a position that's overall quite restrictive on the economy until they are satisfied that inflation is where they want it to be on a sustainable basis.
Okay, fair enough. All right, let's go across to Australia, sort of compare and contrast, if you like. We had the RBA governor beginning of this month, I think it was, saying that interest rates might need to stay higher for longer. So clearly there's something of a substantial policy gap now appearing between what the RBA is doing, what the RBNZ's doing. I'd be interested. I mean, do you think that's sort of sustainable? I mean, can that go on for a long time, do you think, or does it not matter, or or what? It's quite interesting to see these central banks now, seemingly anyway, moving in different directions.
Well, I mean, if you sort of track what the RBA has been doing and the RBNZ has been doing, and sort of put them side by side, there's definitely similarities, but there's just a few little differences in the pace and just how far that they've both gone. I'm looking at them right now. You can see that the RBNZ moved quite a bit earlier than the RBA did back. They started in I think about October 2022, and the that was quite a bit before the RBA raised rates. I think they were about 6 months later, and the RBNZ went harder as well. They sort of went about another, I think, 75 basis points more over that period than the RBA. So it's a similar profile, but it's not exactly the same. And so perhaps it's not too surprising that the RBNZ is now in a position to ease policy more quickly than the RBA is. It's not a huge. I don't think it's a huge gap in where the two central banks are, but it's just sort of perhaps reflects some slightly different circumstances. And again, you would expect there to be a bit of a difference in that case. Now, looking at the RBA, it wasn't too long ago that there was at least a lot of hope building that the RBA would be in a position to cut policy rates in the second half of this year. But it just turns out that the incoming data suggests that that's just not going to be possible. And so quite predictably, we've had the RBA come out and sort of dampen any expectation that that's going to happen. We had the Governor, Michelle Bullock, appearing before Parliament this week, just saying, look, it's really not on the cards for the between now and the end of the year at least. And I think people are getting that message that there's still quite some gap in what inflation, where inflation is, and compared to where they want it to be. They've pushed back their forecast for when they think inflation will be back around the middle of their target range. And so we've seen the resulting shift in what they're talking about in terms of the likelihood of a rate cut.
I was going to ask you about that. I think when it's a quarterly statement on policy, wasn't it?
Yeah.
They're now suggesting that underlying inflation won't return to target until the end of 2025. I mean, is that the kind of shift which might actually force them to even come out and increase rates again?
Look, they've said that they're not ruling anything in or anything out, so that is still a potential. That is still a potential option for them. But I think that they wouldn't really go take that step unless there's quite a big shift in their inflation forecasts. Obviously at the moment they've got a set of forecasts, and with that set of forecasts they decided, okay, we don't need to raise rates at the moment. But obviously if inflation numbers surprise the upside and they have to keep on pushing back that expected date at which they'll be hitting the target, then sure, it will be on the table. We do know that in recent months, the minutes have told us that they are actually actively considering rate hikes. So it's definitely on the table, but just at the moment they've concluded that we don't need to do that. So you can't rule it out, but you could tell that they would rather not do it, because it would cause there would be an uproar basically if it happened here in Australia at the moment. People are calling out for rate cuts, and so if the RBA went the opposite direction, I think they would have a lot of public pressure put on them. So I'm not saying that that's going to influence their decision, but I think if they can hold policy at least until the end of the year, then they'll be happy about that.
Okay, interesting stuff, I must say. All right, then quickly ask you about India. No change from the RBI this month, but inflation now down at 3.5%, so it's below its 4% target midpoint. Again, the same sort of questions. Does that increase the chances of the RBI actually coming out and cutting rates?
No, I don't think so. I think this is pretty much in line with what they've been saying in recent meetings. They've talked a bit about just how there's certain base effects flowing through the CPI numbers at the moment, which are sending them up and down a little bit over the near term. So they're definitely trying to look through these base effects that are sort of shifting the numbers around at the moment. And of course, as always with India, just the volatility in food prices has a big impact on sort of month to month numbers in inflation, and they always try and look through that and not get too spooked if it goes a little bit higher or goes a little bit lower. So they again that said, they always stress that we have to make sure that we don't let any volatility in food prices flow through to underlying inflation or through to inflation expectations. So they're still focused on this sort of keeping policy disinflationary. That's the phrase that they're using. So I think what that means is that that they're still biased towards, I think, keeping rates around the level that they are now, but they'll just keep on monitoring the more the underlying story for inflation rather than sort of the month-to-month volatility. And they're also helped in this by the fact that the activity data continues to be pretty strong, pretty solid. So that's not really causing them too much concern at the moment. So that again, I think just gives them the flexibility to be really focused on inflation and keeping policy focused on trying to get inflation back to within their target range and staying there.
Okay, fair enough. Anything else from your part of the world?
Just there is another central bank coming up this week, actually, South Korea. So the consensus, I think, is for another month of no change. That's sort of been in place for a long time now. I think they've been on hold for nearly 18 months. So at the moment, I think that's the way to go and what we would expect. That said, there was a little bit of a change in the language that they used last meeting. They said monetary policy should remain restrictive, but for the first time in this sort of current sort of policy cycle, they said they are open to considering a loosening in policy settings. And so they said, quite explicitly that we are thinking about a rate cut, but it's just going to depend on inflation, on the inflation data. Now, the last inflation number that we had since that meeting, if I could just find that, I think it did have a bit of a pickup in the headline rate, mainly because of private transport costs or fuel costs, but the underlying number was pretty steady. So it'll be interesting just to see. As I said, the forecast is the consensus forecast is for them to be on hold again this week, but it will be interesting just to see if they give some further indications that a rate cut is being considered.
Okay, watch your space. Right, well, thanks muchly for that, Brian. And we move on to Europe, I guess my part of the world. Well, ECB, then, they're on their summer holes at the moment, so there's no meeting this month. The next one will be on the 12th of September, which will be watched especially closely as we'll get the updated set of quarterly economic forecasts then. And clearly it's these which really determine whether or not interest rates might be cut again. As ever, key will be the latest inflation developments. As we stand at the moment, the July inflation number was up to 2.6 from 2.5%. The core rate flat at 2.9. Inflation services only marginally softer at 4.0. So in other words, the numbers were okay, but hardly great. Next update there will be the August flash figures, which will be at the end of the month, in fact, on August the 30th. And they're certainly going to be important in determining whether or not we're actually going to see another rate cut come September. For the real economy, well, the flash August PMIs, they'll be due out on Thursday, and they're likely to show that growth pretty well remains sluggish in general, and manufacturing still extremely weak, notably in Germany, which has big problems on that front still. Consumer demand, well, at least that looks to be, it's growing, but it's still quite soft despite gradual improvement in consumer sentiment. But while the labour market remains tight, unemployment is starting to rise. The level's actually gone up over the last couple of months, and the rate in June was a tick above May's 6.4% record low. So there are some at least tentative indications that it might be on the turn. July ECB minutes, I should say, will be released on Thursday. They could offer some clues about how the General Governing Council is leaning at the moment. As far as financial markets market's concerned currently, well, they're pretty well convinced that we will get another 25 basis point cut in interest rates, and certainly the relative strength of the euro has made some tidy gains against the dollar over the course of the last month or so. That will help towards that end. So big picture at the moment is, as far as Europe's concerned, interest rates certainly still headed down, just a question of the timing. It does seem that overall the governing council want to reduce interest rates again. So I guess at this stage, and obviously subject to how the inflation data come in, we will see another cut in interest rates come September. Much speculation too about when the Bank of England are going to reduce interest rates again. As folks no doubt saw, they cut interest rates by 25 basis points. Excuse me, bank rate hitting 5% on the 1st of this month. But worth noting that the vote was extremely close. It was only 5-4. So effectively, Governor Andrew Bailey ultimately had the deciding call. At least 4 members are still concerned that underlying inflation pressures remain too high. In terms of the actual data, inflation in July, that actually rose above target. It was 2% and went up to 2.2%. But importantly, the core rate fell. That was down to 3.3 from 3.5. And that's its lowest reading since September 2021. Also within that report, services, which is where the main pressures on prices coming from at the moment, the rate there declined to 5.2% from 5.7. And that's matches its lowest reading we've had since May 2022. So inflation numbers, if anything, heading in the right direction for those favouring an interest rate cut in September. The other side of it, of course, is what's going on in the labour market. Well, the latest we've had there in terms of regular average earnings that the bank pays quite a lot of attention to. Growth there was 5.4%. My latest numbers down from 5.7, and that's the weakest reading we've seen there since almost the end of 2021. So putting it all together, the chances are that the doves on the MPC will likely be pushing for another cut in rates unless the August CPI, and that will be released just a day before the Bank of England's announcement, or indeed the next labour market report, which will come out a week sooner, unless they're particularly poor. However, that said, by and large, the real economy has actually held up pretty well. Growth in the second quarter, GDP was up 0.6% quarter on quarter. That was well above the original market and indeed Bank of England expectations. And that came after a decent 0.7% rise in the first quarter. So broader picture is that the real economy has actually performed surprisingly well during at least the first half of the year. So pressure for a rate cut from that particular quarter is not what it might have been. Of note, I guess, just looking at the composition of the MPC, something given just how close the vote was last time round, this sort of thing could matter. We'll get Jonathan Haskell, who was one of the guys who voted against an interest rate cut last time. He will be leaving the MPC soon, and he'll be replaced by Professor Alan Taylor. Now, it's normally, I guess, reasonably safe to assume that the incoming new person will tend to vote with what the governor thinks. So the removal of a hawk and potential replacement by someone's likely to be more neutral, perhaps even dovish, depending upon how the governor votes, that at least slightly increases the chances that we could see rates coming down again in September. But there's still a fair bit of data between now and the meeting itself. That'll be on the 19th of next month. So markets pretty well split as to whether or not we will see a move. And I must say at this stage, it's probably still pretty well 50-50. But either way, rates certainly look as if they will be coming down again before the end of the year. Let's quickly round off with the Swiss National Bank, where, to be honest, there doesn't really seem to be much to stop the SNB from cutting rates again next month. In terms of inflation numbers, which of course are so important to the Swiss National Bank, in July the headline rate was just 1.3%, so amongst the lowest anywhere in Europe. The core rate was even lower still at just 1.1%, so there's not a problem there. Indeed, inflation has been well below sort of the 2% benchmark rate that people look at for over a year now. Also important to the SNB is the exchange rate. Well, the Swiss franc is currently trading pretty close to the 0.95 francs versus the euro, which from the SNB's actions and comments in the past would seem to be pretty much where the central bank wants it to be, so not a problem there. Also, in terms of the real economy, Well, it's growing, but it's only growing slowly and at a weak enough pace to pretty well maintain a fairly solid, if still quite gradual, uptrend in unemployment. In fact, joblessness now has been increasing every month since February of 2023. So unless something surprising happens between now and the 26th of September, which is the next SNB monetary policy assessment when they'll make their interest rate announcement, looks a pretty decent chance that we'll see rates coming down, official interest rates coming down by another 25 basis points then. Okay then, right, well, we'll end it there then for this edition of the podcast. It's interesting how, well, at least until recently, sort of a surprisingly weak US employment report would probably have been interpreted favourably in financial markets due to its potential implications for lower inflation and hence an earlier cut in Fed interest rates. However, now we've got this renewed talk about a possible hard landing and some concern that the Fed has been too slow to cut, all means that reaction is much less predictable. However, in any event, the focus inevitably remains on the data. So do make sure that you keep up to date with what's expecting, what's actually happened, and what it all means in Econoday's global economic calendar. On behalf of Terry, Brian, Max, and me, thanks as always for listening, and we'll be back again very soon. Bye for now.